Welcome to the daily update, where I'll go over the action in the market for Monday, March 24th, and we'll see how things look for Tuesday, March 25th. Had a nice little bounce. Haven't seen one of those in a while. We're seeing some improvements. In fact, we've actually switched to positive in the short and long term. We were able to get back above the short and long moving averages. We're still negative in the intermediate term based on moving averages. And we didn't really see all that much improvement internally. There was some, and I'll go through it here, but we need to see more follow through. There was a real relief over the weekend that the tariffs are being modified in a way that the market liked, and the futures were positive and just kept gaining momentum through the night. That gave us a much higher open, and we were able to hold on to those gains and close pretty much at the high. So, right at the open, we had a gap higher open above R2 at 57.15. I had been pointing out that 57 as a round number, psychologically speaking, that might be a good down point, but 5700 might be overhead resistance. We didn't even get near that. We opened up above 5700 and just stayed there, and we climbed up to 5750. Then we stayed above the 5750 for the most part and closed at the intraday high. There was this initial thrust up, and then we just kind of drifted off. It's one of those smokestack days. You'll see that when I get to the chart. We were up 1.76%. This is a concern on below average volume. On a good solid upward move, you want to see a pickup in volume. That was not there. And we are now positive in the short term, negative in the intermediate term, and positive in the long term. Interest rates and the dollar ended up going up. That could have pressured both stocks and other indexes, but it didn't. And so that seemed to hold together fairly well. All right, so some comments. There is optimism that the Trump administration may adopt a more targeted approach with these tariffs that are supposed to kick in on April 2nd. And that the market liked that. Instead of just putting some kind of blanket tariff on a country applying to everything, they're trying to say, okay, how can we be more surgical with this? The Dow and the S&P were able to regain their 200-day simple moving average. So that's positive in the long-term aspect. Mega caps had a pretty good day. They've been really beaten down lately. This whole buy the dip thing was really not doing very well for folks. Well, they kind of got paid back a little bit on the positive side in Monday's session. The VIX is continuing to drop. This is the fourth trading day now that we've been able to close under 20, and we're dropping even further at 17.48. And on the extreme positive side, we still have the Stochk RSI. That's been there for two trading days now. And now we're oversold when it comes to the ADX, but you have to use reverse with that. It was an extreme negative reading, but it looks positive on the chart, and I'll point that out. And the slope oscillator is also still giving us a really extreme reading, but it's turned up and it's above its moving average, so you could call that positive. In the intermediate term, we're still oversold barely with the TTM squeeze, but you could call that positive as well. It's really been rising up. And in the intermediate term, we have the CMB composite just barely giving us an extreme positive reading. We still have a non-confirmed Hindenburg-Ullmann that was generated on March 3rd. We have until March 31st to see another spike on that chart. It has not happened yet. No changes to the overall scenario concerning the Fed. They didn't cut rates last week at their meeting. They lowered their projections for GDP. They raised their projections for inflation. The dollar was up, interest rates were up. We closed at 4.33% with the 10-year yield, where after Friday we were at 4.25%. And we're finally out of that extreme negative area as far as sentiment. We had been camped below 25 for a couple of weeks at least, and we saw enough of an upward move that we were able to get to 28. We're just negative instead of extreme negative, where after last Friday we were at 23. We're not inverted currently with the 10 to the 3-month yield curve. That seems to be kind of going in and coming out depending on what kind of a day it is. As far as our trend, we're still negative with the trend. And but we are weakening both in the short and intermediate term because the ADX is dropping below its moving average. That doesn't mean a reversal of trend. Well, it could mean that, but it's not necessarily what we're looking for from that indicator because we're still negative. The red line is still above the green line. And because we had an up day like we did, the bias is positive, and I've changed the momentum mixed to positive. As I go through the charts, you'll see that, yeah, there was some improvement, but maybe not as much as should be expected. Okay, we just had two economic reports that came out, the S&P Global US Manufacturing and Services PMIs. The takeaway from this, and I don't have charts to show of this because really we just look at the numbers here. Are we above or below 50? Above 50 shows expansion, below 50 contraction. We're at 49.8 with the preliminary reading, where last time we were actually above 50 at 52.7. We're still up pretty strong here with the services, 54.3. Last time it was at 51. So no charts to show you this time. This is looking at margin debt. We're coming up to the end of the quarter, and that's when a lot of numbers are calculated for this. And this is using borrowed money to buy stocks. So if you have $10,000 in an account and it's a margin account, you can buy $20,000 worth of stock. Now that's great when everything goes in your favor. But the $10,000 that you borrowed from your broker that you have to pay interest on, you have to pay all that 10,000 back. It's not like you're going into a 50-50 partnership with your broker. If you lose value in that, you still owe the full amount back to the brokerage firm. And if you can't meet those obligations, you get what's called a margin call. And you might have to sell because you don't have extra money that you can deposit into your account. Well, this is the latest reading where it had been going up, and that's typical. When the market is positive, folks are willing to buy stock on margin more and more. It's been coming down a little bit so far in 2025 because it's been a difficult year so far. Then, whenever we start going down, there's this continued and kind of talk about the valuation that we're overvalued. Well, nobody was really talking about that too much when we're going up. They just talk about it when we've been going down. And I go over this in the weekend video, in the intermarket analysis video, where we look at the valuation of the S&P on a historical as well as forward-looking basis. And we're coming in at about 21. Now that's above the scale that we use of 10, 15, 20 for PE ratios. And then it breaks it down into the 11 different sectors that make up the S&P. At the top, you have tech, that's 25, so it's above, well above that 20 level. And discretionary and even staples are getting kind of expensive now. And then way at the bottom, that's more fairly priced, is the energy sector. And they've been coming on a little bit lately, and that tends to be more of a defensive play. So we're keeping an eye on that. But this just gives you an idea what the PE ratios are for the different sectors. Then foreign investor ownership, 18%. Dropping down here with the equity allocation with the CTAs, the commodity trading advisors there, they're actually dropping off a little bit, which is to be understood where there's uncertainty and the market's been in decline. Then foreign ownership of U.S. equities. Europe owns most of them. We'll see how long that lasts. Europe and the U.S. are not getting along all that great these days. It's not like we had a revolution with England in the past or anything. And then you have the Americas at 25%, Asia, the Middle East, and then Oceania, which is that region right next to Pollyanna. But it's Australia, New Zealand, and all the different islands that are in the South Pacific there. And then discretionary versus systematic strategies. Some folks just use a system. They don't really look at the market. They don't really pay attention to it. They might use dollar cost averaging, or a certain amount every week or every month goes into the market, and they just follow a system. And it doesn't matter what's really happening. Where other folks are discretionary. Now, don't get that confused with the discretionary sector. Discretionary here means they can use their discretion to get in or get out. And when we're under pressure, the discretionary tends to hold up better because folks, oh, I see things are not going really well. I'm going to get out of the market. Where the systematic type strategy, you stay in the market, and so you go down with the market. And we see this between managed and non-managed mutual funds and even ETFs, where the managed funds, that's you could say that's discretionary because there's supposed to be a professional that manages the ETF or mutual fund. They can move with what's happening in the market, where the systematic approach would be like an index fund, the S&P 500 fund or something like that, where it just rides with whatever way the market goes because that is the market itself. And so when we're really going up, the systematic approach tends to do better. Where when we're going down, the discretionary type approach tends to do better because people can get out. But then they don't do as well when we're going up because sometimes we're having a little bit of a pullback and they sell and then they miss out on gains, or they listen to either perma bulls or perma bears and they make their decisions based on that and they miss some kind of a big move that they could have taken advantage of. All right, I found a few interesting things here on Twitter. This was the reason for all the optimism in Monday's session that the White House narrows the April 2nd tariffs. Tariffs on industrial sectors no longer expected to be unveiled on that date, though major trading partners will still be hit with reciprocal tariffs. You tariff me, I'm going to tariff you. Yes, eye for an eye. There we go there. Then Bostic was on the FOMC. He said that he sees only one rate cut, where last week they came out and you could make a case that the Fed might be open to two rate cuts. So didn't seem to have much of an impact, but it was said anyway. Then this was put out by Chris Schiavocco. This is looking at the NASDAQ, and I focus more on the S&P, and these are Fibonacci lines where we go from the October 2023 low up to the high that was set. It should be here in February. He has, I guess it was an intraday high for the NASDAQ that was hit first back in December. We've come down to this 38.2% retracement level, and so far this level is holding. It'd be really beneficial if we could bounce up above that. I'll be watching this. I have a chart of the same thing. I just saw his and he makes them all pretty and everything. So we'll see if we get some more upthrust out of this from support. But if we break down below it, we'll be keeping an eye on that as well. And then tracking seasonal trajectory. And again, seasonality, it's a strange thing because if you go back over the last 100 years, you get a series of results. If you go back over only election years, you get another series of results. This looks at going back to 2020. And so it's more recent. And some folks think, well, why were we comparing it to 1947 and 1963? We should be looking at what the market's doing right now or what it's done in the recent past. Okay, I can see the argument for that. But it just shows here the last 5 years, 2020 to 2024, this is what has happened. We're typically will top anywhere from January into February, and then we see some weakness. And then right around March 23rd, which we're beyond that now, that was Sunday, we tend to see a bounce up from that. And that's kind of the pattern so far that we've been following in 2025. We'll see if we stick to that basic pattern going forward from here. Then VIX futures, large speculative positioning. They're getting really high readings here, which means they're anticipating that we could be at a bottom. But there's been other times they've had high readings too, and we were not at a bottom. The market just thought we might be at a bottom. But this is just one thing that could end up being positive for the market. And then the equal weight, how it's doing, the 10-day average, it's been holding up better. And it has a lower PE ratio. And that's why when the market starts talking more about valuation and the mega caps and all that, they're the high flying stocks. And we've been seeing rotation into other stocks in the S&P 500. That's why the advanced decline line and even the new highs, new lows to a degree have been holding up during this downward move. Even though the index has been coming down, that's mostly weakness with the mega caps. Well, the rest of the S&P has been holding up fairly well. In fact, last week, the equal weight version of the S&P outperformed the weighted version. And we're right at around 16.9. That's more fairly priced on that 10, 15, 20 scale. Okay, so not an awful lot to show here as far as analysis. This, like I said, a smokestack day where we just immediately shot up above R2. We got above this 5750 level, stayed above it for the most part, drifted down saw a little bit of buying here and pretty much closed at the high for the session. And down a little bit in the initial overnight session here, but it was the when we opened up here, well, this is the close on Friday. We did spike up because the news came out over the weekend. That's why in the program that I have, I really teach hedging because it may have worked in your favor this time. But remember when DeepSeek came out and other tariffs were announced, and this was all announced over the weekend, and maybe you don't have any hedges on your positions and you just get hit when we open Monday morning? Well, this time, if you're long in the market, it would have worked more to your favor, where we gapped up and then with the futures anyway, and then we just kept going up. Now, Europe was down, but the S&P futures were up, and then we just carried that over into the cash session. And now, just not, this is one of the subtle things under the surface that I'm talking about here, where the red line is still above the blue line. That means value is outperforming growth. Now, we can still go up, but at some point, to really take the market higher, we're going to need growth to outperform value. And it would be even more helpful if the mega caps really came in and started to participate more than just one day here and one day there, and not really seeing much of an improvement, but it's not breaking down either with the growth to value ratio for the S&P intraday. Now, the end of day charts showing this here, we were up 2.5% with growth, 1.21% with value, and then almost 3% for the mid caps and 2.87% with the small caps. So, yeah, just green all across the board with lots of high numbers. And so we showed some improvement, but there's a lot of damage that needs to be repaired. We just recaptured the 200-day moving average with the growth to value ratio for the small caps. We were above it after Friday with the mid caps, and we are showing some more improvement there. And we've got a long ways to go to get back to the 200-day moving average with S&P growth to value as well. And coming back up, but not even to the underside of the rainbow yet with the growth to value measure here, and coming up a little bit, but still a ways to go when we look at discretionary versus staples. Now, this is the trend that I'm talking about here, where I'll get to the short-term chart in just a moment, but we're coming down now. We're dropping below the moving average. That means it's still a negative trend. It just means that it could be weakening. This whole downward move that we saw, maybe that's going to fizzle out for a little while. Doesn't mean we're going to reverse. It doesn't mean we're not going to reverse. It just means that this trend is starting to weaken. And we can see that because price has been going back up, and that's causing ADX to show weakness. We're still negative because the red line's above the green line. Now, if we see some more follow through and the green line crosses above the red line, then we would change to a positive trend. This is what I'm talking about. We're above 40. It's coming down, and we're just barely dropping below 40 now with the short-term ADX. That's when we pay attention to this, is when either the black line, which is the ADX, or one of the red or green lines, whether they go above 40, that usually doesn't mean we're going to stop right there. It just means we start watching it closer because we could be getting ready to slow down. And we did drop below average with volume. That's also shown here, where we had that huge spike on Friday because of quadruple witching. And then we dropped to below average here on Monday. Sentiment, we're right about at the middle. When we look at this is a weekly chart. I like to look at something that updates more regularly, coming in at 50.94 and slightly into bullish territory here when we look at the legal insider transactions, folks that buy stock that work for that company or own part of the company who are corporate officers in that company. They have to report when they buy or sell. And this is looking somewhat bullish right now. And just to kind of go along with that, I show the insider buying ETF. This is an ETF that tracks what are the insiders and companies actually doing. Well, they haven't been doing all that well here. 2024, you would have missed out on a lot of gains if you try to use this tactic. But then back in late 2023 into early 2024, you would have done really well. So this is just one strategy that people can use. In fact, we're just getting ready here to see a death cross with this trend for this ETF. And here's another sentiment gauge still dropping down, but not as low as it was in the past. We're seeing other sentiment indicators that have been extreme negative for a while, like the fear and greed index that we follow, the individual investors, the investors intelligence. A lot of those folks are getting extreme negative. This one is negative, but not necessarily extreme. The Ulster Index is coming down, but still well above its moving average. We are dropping with the VIX. We're dropping below the moving averages here on a closing basis and with the bar chart. And the VIX of the VIX is going down even faster. It's actually been weakening before it. And this is a volatility of the VIX measurement. We are going down with the momentum of the VIX. That's more positive. And we went up with this fear gauge and we went down with this other fear gauge. So a little bit of a contradiction there. And we did tick up here with the risk on versus risk off ratio. So, but we need to see this keep going up, not just come up here, stop, maybe go back down, chop around, do whatever. We need to see some conviction behind this to turn more positive. And we declined with the equity put call ratio. Not a surprise there on an up day. That means there were more calls than puts. When this goes up, that means there's more puts than calls that are being bought. And we're going down actually kind of fast here with the 5-day chart, and we're also declining with the 10-day chart. So the fact that they're declining is considered positive. And we're really dropping below the band even more with the volatility risk premium. And the advanced decline line holding up, didn't really fall apart all that much. And it didn't really bounce up all that much in Monday's session. I mean, it was up, but it's not breaking out. And we still haven't come back to this previous high here based on volume. So it's positive, but not but not showing any massive strength, at least at this point. We did cross back above zero with the advancers decliners, but we've been chopping above and below. We could have a down day on Tuesday and this will drop back down below. So we're not, we want to see what's really moving either up or down with this indicator. It's just chopping around. Still going up with the 5-day moving average of new highs, new lows, but we're flat to slightly declining now with the 10-day average. And we're above the midpoint here with the advanced decline ratio, short term, which is 19 periods, as well as intermediate term, which is 39 periods. And this was a big improvement for accumulation distribution. We're above the moving average and really saw a nice spike up there. So this is smart money indicator number one that's positive. We're now back to positive with the chicken money flow. We were improving after Friday and starting to turn positive. This is just confirming that. And we're actually coming up above this red line here, but the Chaikin oscillator is also positive. So for the first time in quite a while, we're seeing the three smart money indicators all giving the same reading at the same time. And right now that's positive. And Vortex is still negative though, but the red line's going down as the green line's coming up. And this can be considered positive because the S&P is back above the moving average here with the advanced decline line studies. We're seeing improvement with the NYSE common stock, mid caps, and small caps, but all three of those indexes are still below the moving average. And we just barely crossed back above 50 with the stocks inside the S&P above their 20-period moving averages. We're improving, but still below 50 with the 50-period moving average study, the 100-period moving average study, and getting close, but still slightly below it with the 200-period moving average study. And here's the daily chart. It's really hard to see because we're getting ready for April to happen here. And so the pivot points start drawing even before that point. This will come out better on some different charts. We did see an improvement with the 20, 50, and 200-day moving average study of the S&P. We're extreme positive with the Stochk RSI, almost up there, but not quite with the Williams percent R. Also getting close with the CCI 14. A little bit further behind is the CCI 20. It's based on longer periods, so it takes a little longer to move, but it's still designed to be for the short term. Nothing's extreme right now with the stochastics. We're going up in the short term. We're coming back up to the midpoint in the intermediate term, and we're crossing above the lower end here with the long-term stochastic. And you could make a case that we're a little overdone here with the force index. We're barely hitting the upper Keltner band. And when we hit that, that means we've gone up pretty far, pretty fast. We're seeing a real improvement here with the short-term trend. The double and triple exponential moving average study, we're above both of the lines, and now both the lines are starting to turn up. The longer we can stay above this, the more that's going to look even better. And we did get back above the simple and exponential moving averages. So that's why the short term is now considered positive. And we're above the midpoint here with our standard deviations chart. That's switching back to positive. We crossed above the midpoint with the balance of power. That's positive. And here we're just barely at this black line here. And again, as I like to point out, I put the black line on here. There's nothing magical about it. I just kind of eyeball it. And then usually I pick a round number and go, okay, that's a good place to put it. This is just when we start watching it. Doesn't mean we're going to stop here and turn and go the other way necessarily. And we're finally back above the 200-day simple moving average. We were red there for a while. Now we're back to a little teeny tiny speck of green. And still looking more negative here, but improving with the go no go system with the lighter purple. And crossing back above the midpoint with the highest high, lowest low value chart. And the TTM squeeze, we're still just a little bit below this black line. That's why I'm calling it extreme negative, but it's a lighter shade of red and going up. You could call that positive. And we're just a little bit above the moving average with standard deviation. We're moving kind of fast over the last 10 sessions. Improving, but still negative with the ease of movement. No move here with the Arun. It took a 3-day weekend, apparently. And the McClellan oscillator is back above zero. But see how choppy it's been? We did have one real drop down here, but it's just been dancing around the midpoint, not really showing an awful lot of conviction. So we're going back up after we were starting to go down here based on price, but we continue to go up based on volume. Now we're seeing signals that confirm each other. Where after Friday, price was going down as volume was going up. And we're still above zero with the McClellan oscillator for the NYSE. So we're back to going up with the NYSE summation index based on price and volume. But we're still going down with the Swindler trading oscillator. It didn't pick up anything positive. So it's continuing to decline. And we are showing a sign of improvement here with momentum. The PMO not quite above its moving average, where when we break it out based on price and volume, we have crossed above the moving averages. Seeing an improvement with the PMOs that are rising. The buy signals are going up, but we're still flat with the PMOs that are above zero. And we've gone from neutral to positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. And this is also giving an extreme negative reading, but we're going up above the moving average, so you could call that positive with the slope oscillator. The MACD is starting to turn back over positive. So the short term is back to positive. The intermediate term is becoming positive. We still have the PMO that hasn't quite crossed, but these other momentum oscillators have. And we're turning up. It's still negative in the long term with our oscillators. The Copic curve is now positive, and we're no longer extreme negative with the Sean trend meter. We're still below 50 with the money flow, but it's at least it went up. And we're above 50 and advancing with the ultimate oscillator, so that's positive. We were able to get back above the moving average with unbalanced volume. That's potentially positive if we can stay above there. And we're just about up to 50 with the RSI 14. That's intermediate term, where we cross back above 50 with the short term. And this is a condition of the intermediate term trend based on 50 periods. We're just coming back up to this blue line here. Is that acting as overhead resistance? It might be. But if we can continue to go up, eventually these lines will turn and go back up, and that would be more positive. And we're still below the 50 period moving average. So we might be above the 20 and the 200, but we're still below the 50 and we're still below the 100, our more intermediate to somewhat long-term moving averages. And this shows all of them together, where it's because the 20 period moving averages were coming down and actually they themselves were dropping below the 200-day moving average. But these other moving averages, 50 and 100s, they are slower. So if we keep going up, we'll be watching these areas for overhead resistance. And we did break through finally. This light blue line here, we were able to get above that, and we actually closed above this orange line that was another low that was set after the low a year ago. So we did have some positive action here getting above this overhead resistance. And we're crossing above 50 and going up with the bullish percent index. So that's positive. We're going up with the NYSE bullish percent index and really going up nicely with the NASDAQ 100 bullish percent index. Still waiting to see if we're getting the third part of a signal here for the mass index. It hasn't happened yet. And we were able to get back above the 61.8% retracement level with the Fibonacci. Can we stay above that? The longer we stay above that, if we do start to decline, it has more of a chance of that becoming support. But we did lose this before, where 50% is holding up at a better support level. And this is the 20 period simple moving average of the open, high, low, close. When we come back up into the mini rainbow, quite often this will act as overhead resistance. We'll see if we can break through that. Long-term support is holding. This pivot point right here, so far we're bouncing up off of that. And we're turning back and looking more positive with the hike in ASHI. We're looking positive with the KIGI chart, the Renko chart, and the 3-line break. So our trend-based indicators like what happened in Monday's session. And we had another X drawn in here with the point and figure chart. So that's positive after getting three X's drawn in last week. Long term, we are seeing an improvement with the 150 and 200 moving average. We're just a little bit below the 250 level here, which is considered to be the midpoint. And a little bit of a change here. Apparently, someone is updating this, where this is more of a macro look. We're still negative in the short and intermediate term with stocks. Now, bonds have switched to negative in the short term. Commodities are positive across the board, and the dollar is still negative in the short and intermediate term. And then looking at the different indexes, we actually switched to positive with the mid caps and the small caps, which is interesting. They've been really lagging behind, and so some folks are trying to buy the bottom of this whole thing. Only one sector ended up being down, and that tends to be more of a defensive one, utilities. We had discretionary and tech leading, and that's what we want, but we need to see more of that. Communication was also up, so that's good, but we need these three areas to do well if the market is going to turn more positive. Nothing but green or blue here. And we had a utilities bullish percent index across above 80 right at the open here, but then they ended up being down on the day. The financial sector, we like that. It got hit with everything else, and now it's starting to cross back above 50 with the bullish percent index. Discretionary also crossed above 30 after getting hit there. That's Tesla and Amazon. That's been really hammered a lot lately. And then we see where the Nasdaq got above 17.8, then 17.9, 18.1, 18.2, 8. I missed 18 here. We got above 5,700 with the S&P. The Dow got back above 42,000. Canada got above 25,000. Staples had a BPI cross above 50. Now that's a little more defensive. Industrials, that could be a little more cyclical, but that could end up being positive. Communication, we like that. That's a growth area. We're having a bullish MACD crossover there. And we had a BPI cross above 50 with the bullish percent index, which I just showed in one of the previous charts. We did get the 200-day moving average for the Dow back, so that's positive. And we're positive with the Elder's Impulse system for the diamonds. A lot to go to get to the 200-day moving average with the NASDAQ and the NASDAQ 100, although the NASDAQ 100 is a little bit closer, but we're not close enough yet to really consider that overhead resistance at this point. And we're positive with the Elder's Impulse system for the Qs. The momentum for the NASDAQ 100 is now turning positive. And we are going up with the small caps, but we just generated a death cross, which, as I pointed out before, it's not uncommon to see we change to an uptrend and then things pull back. We change to a downtrend and then things bounce up. So we'll have to see how this plays out. But we're right at this S1 support level here, which, since we're coming at it from underneath, that would be considered overhead resistance. And not quite at a death cross here with the Russell 2000 small caps, showing some improvement, crossing above 50 with the RSI, and the momentum has been positive. And we're positive with the Elder's Impulse system for the small caps, also improving and coming back above this S1 level with the mid caps. A little bit further to go before we see a death cross here, and positive with the Elder's Impulse system with the mid caps. And we're coming back up to the 50-day moving average with the financial sector. So that's showing a nice little comeback there. And we were able to get back above the 200-day moving average with the bank ETF, but there's some damage there. We want to get back above the 50. The Wilshire is right a little bit above the 200-day moving average. That's a broad market measure where we were actually able to go a little bit above the moving average, the 200-day moving average with the total U.S. stock ETF. We're above the moving average here, the 200-day moving average with the FANG index. So that's showing some improvement there. And then we're seeing a death cross now with the Dow Jones Semiconductor Index. This is what led us higher back in late 2022 into 2023. Is this telling us that things are getting set to go lower? Now, if we can keep bouncing up and get above these lines and turn them back up, that would be positive. But this is a concern to us right now because semiconductors are such a huge part of tech, which is in tech such a huge part of the whole market. Apple still not back up to its 200-day moving average. We're actually above the 200-day moving average with Amazon. Microsoft in a downtrend. It was up as well. Google not back up to its 200-day moving average. Bouncing off the 200-day moving average a little bit more here is Meta or Facebook. And we're seeing a death cross here with Nvidia and still below its 200-day moving average. Tesla, just a little bit below its 200-day moving average. It's been getting hammered as now, instead of Teslas being the cool car to own and that you're hip and you're into the Green New Deal and all that, now it's become uncool and they're getting vandalized like crazy. And Netflix, which really has held up fairly well, is back above its 50-day moving average. We're still going down with this ratio, and that's positive. That means staples are underperforming tech. If that can continue to fall, that would be even more positive. And we're seeing a little bit of a strengthening here with the short-term correlation between US and world stocks, and the longer-term correlation continues to weaken. We're still below 70 with oil, just keeping an eye on that, mainly for geopolitical reasons. The dollar did bounce back up, but it's not back up to its 200-day moving average yet. And we went up with the 10-year, but we're kind of range bound here. We're hitting the higher end of this range. Are we going to hit this range and then turn and come back down, or are we going to break out of this range? That'll be somewhat telling depending on what happens. And we came down based on price. Could these areas down here end up being support? And we're no longer inverted with the 10 to the 3-month yield curve, but I'll just keep watching that. And some improvements, but not turning positive with our growth to value ratios, coming back up to a declining moving average with the large caps. Mid caps are a little bit above, and small caps got a little bit above. And then we look at the Qs to S&P, right up to a declining moving average. Same with discretionary to S&P. We still haven't come back up to the moving average when we compare large cap growth to value. And this spike coming down could also be positive. That means staples are underperforming the S&P. So what's our outlook for Tuesday? We're still negative. Actually, we're above the 200-day moving average. We're positive in the short and long term. So I didn't update this, but we are showing signs of improvement. We're going to get the FHFA Housing Price Index, the S&P Case-Shiller Home Price Index, and consumer confidence will be coming out, as well as new home sales. And then anything geopolitical or just plain old U.S. political, and with Canada, Mexico, Russia, Ukraine, any of those things that could come into play, and all the tariffs and trade wars and potential trade wars. And then on Wednesday, we'll get durable goods. We'll get our initial jobless claims on Thursday, and then the third reading of GDP. The big one is going to be Friday with the core PCE coming out. That's an inflation gauge. And here's also a look at the calendar for the upcoming week here. Seasonality, we're positive for March 25th across the board with the Dow, S&P, and NASDAQ. This is the week after options expiration, though, which tends to be negative more than positive going back to 1980. But seasonality-wise, we're actually seeing a little bit of a convergence here. The solid lines are going up. That's all the years together. The green dashed line, that's in a post-election year. And there, for the next couple of days anyway, we do see some positive seasonality. And the second half of March, it's going to not be hard to beat the first half of March this year. Okay, so our 3 smart money indicators are now positive. This should be on the positive side, but for some reason I didn't put it there. So just tuck that into the positive side of your brain. The Swindon Trading Oscillator is still declining. We're improving. We're getting above 50 with the 20-period moving average study. We're improving with the others, but they're still the 50, the 100, and 200. They're all still below 50. These movement is still negative but improving, as is the money flow. The vortex also negative but improving. And the long-term special K oscillator, that we get one signal every year plus with that one. And it did cross over negative. So I'm just mentioning that here, not showing the chart of that one. On the positive side, should be the smart money indicators. And we're seeing an improvement here with our growth to value ratios. We need to see more follow through. And the equity put call ratios, 5 and 10-day charts, they're both going down. That's positive. And we're turning positive here with the S&P in the short term. Intermediate term is just about ready to click over positive, and we're still negative with the long term, with the momentum. And the S&P and NYSE McClellan oscillators and summation indexes, they have switched back to positive. And the bullish percent indexes are now back to positive for the S&P, NASDAQ, and NYSE. The parabolic SAR is positive. The Copic curve is positive. The financial sector is positive with banks above their 200-day simple moving average. The ultimate oscillator is positive, and the momentum for for the NASDAQ 100 is positive. So our conclusion, we're still negative. I thought I changed this. We should be positive in the short term. I didn't change the upper part here, but we're back above the 200-day moving average. Yeah, see, here's where I changed it. We're positive in the short term and showing signs of improving, but we're still negative but improving in the intermediate term, where we're back to a full-on positive look with our long-term trend. Thank you. I hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.